are here today with the wonderful Keith Rabois, who is a longtime operating executive who worked at PayPal and Square and has been a partner at Khosla Ventures for the last few years. Welcome, Keith. Thank you for being with us.
Pleasure to be here.
So to start, I think a lot of people who are going to be looking at this are probably your peers or want to be your peers or just sort of venture geeks. So I thought we could maybe talk a little bit quickly about Khosla Ventures.
Sure.
How many partners are there now, and how does the decision-making process work?
So that's a good question. I don't remember how many partners we have, somewhere between 4 and 8.
Okay.
We're always recruiting more, so if any geeks are watching and want a job, let me know. Just email me, KR, Khosla Ventures. We invest in technical breakthroughs from the very, very early stage to about a Series B. We look for massive market opportunity with major impact in the world, and that's predicated on a technical breakthrough. We've been innovating and helping entrepreneurs innovate in healthcare, particularly reinvention of food and agriculture, as well as traditional enterprise software and consumer products.
When it comes down to actually making a decision, is it 5 votes wins if there's 8 partners, or if it's...
No, actually, usually it comes down to, is there one champion in the firm who's very passionate about something? Mm-hmm. So the level of conviction of one partner can lead to an investment. Obviously, as the investment size increases, there's a little bit more of a process, but it really does come down to, is there someone who really believes fundamentally this is a great entrepreneur chasing a great opportunity?
Okay, and I think people are also just interested in how involved Vinod is. The name's
Vinod's super involved. He still works probably harder than the rest of us. Many entrepreneurs we work with get phone calls from him at 10 p.m.
Is that right?
Yeah, he works at least 6 days a week, so he's extremely involved in many companies, and probably has led the most investments over the last 3 years, or at least one of the 2 most investments among our partners.
Okay, like he was at Disrupt and was speaking very passionately about your portfolio, so I'm not surprised to hear that. So I thought what we could do today is talk about what's in the news. You always have a very strong view on things, which I love.
Only on some things.
Well, one thing that you've been talking about for a long time is IPOs. You've been really beating the drum saying companies go public. Yep. There's many more advantages to being a public company than a private company. But at this point, it seems like companies have less of a choice given what's happening to them once they do go public. What do you think?
I think they have a choice. They have a complete choice as long as their business fundamentals are sound and they have a real product roadmap and are in an interesting market. People forget Netflix went public at a $450 million valuation. Amazon went public at roughly a $350 million valuation. Apple went public at a $1.4 billion valuation. Google went public at a $25 billion valuation. It doesn't matter what price you go public at. It matters what you're actually executing. Have you created a network effect? Do you have in true fundamental innovation and serious leadership?
And so do you think the companies that have gone public, I mean, almost all of which have done poorly, just haven't had those things?
I don't think most of them have done poorly. Tesla's up 10x since they went public.
No, not the ones that you mentioned.
Yeah, the ones
more recently. Those companies all went,
well, they went
in one direction. But
they've done very well. I think that it does come down to public markets are very relatively astute evaluators of the company's prospects in the future. And usually where there's a gap, it's because the founder, CEO, and CFO are not communicating why something's interesting extremely well. But not everything is worth $100 billion. There's companies that are worth $1 billion, which is an amazing accomplishment. Mm-hmm. To build something from scratch in, let's say, 7 or 8 years that's worth $1 billion is an incredibly rare event. That doesn't mean that company is a $10 billion company or that $10 billion company is a $100 billion company. So there's nothing wrong with being a $20 billion company. But the most innovative companies on the planet are all public companies. Ask anybody what the most innovative companies on the planet, and the list usually is Apple, Google, Amazon, Tesla. None of those are private companies. Facebook. So with the right leadership, you can be more innovative as a public company than as a private company. So I completely don't buy that. Secondly, there's a lot of advantages of being a public company. You can acquire things with a currency that people value. The increase in transparency is excellent. If you need access to debt, the opportunities to raise capital from a debt side are much better and much broader. So most of these are just advantages. So I think most companies should prepare mentally, physically, emotionally to go public sooner rather than later. It's kind of a binary outcome, because if you don't, then when you do need capital or you do need some of these advantages, it may be more difficult to get that. But once you pass, it's like sort of like passing an exam. Mm-hmm. Once you pass the exam, then you have the license to leverage the opportunity, however strategically most interesting for your business.
Okay. Why Combinator? Last week they announced a $700 million growth fund. VCs seem not that excited about it, especially I would imagine growth stage investors. Should they be nervous?
Well, Y Combinator has become the most important, change in Silicon Valley in the last decade. I think they've created a network effect around what they do, which is incredibly rare in investing. So I'm a little bit jealous. Fortunately, we're not a growth stage investor, so we don't really, have any, concerns about the growth fund. But if I was a primarily late stage investor, a lot of the best late stage investments over the last decade are Y Combinator graduates. So you could see that would be very threatening to these new sources of capital, let's say hedge funds and all these private wealth individuals coming into the startup ecosystem. I think are going to have trouble competing with highly qualified sources of capital.
I agree. Also, AngelList, another sort of disruptor, just not quite raised, but is going to be managing $400 million from this giant private equity firm based in China. It's exciting, but it's hard to see how you put $400 million in seed stage companies.
I don't think that there is a shortage of capital for seed stage companies, particularly in the United States. More of my time and more of my expertise is based around companies based in the United States and targeting the U.S. consumer base. In that market, I just don't see difficulty raising capital for entrepreneurs with quality teams, quality ideas, quality markets. So I don't know where that money is going to go. Is it going to substitute for other money? But the shortage is really among entrepreneurial talent. The high caliber entrepreneurs are very, very, very rare. And when you find one, you definitely want to invest. And I don't know if this extra capital is going to be allocated to the right people. That's hard to tell. I mean, I was an early fan of AngelList. I was an advisor to AngelList. Actually, I highly recommended Uber place their offering, their initial seed on AngelList, which worked out really well for everybody involved.
Right.
So I'm a big fan, but I don't know how this is going to play out.
I also wanted to ask you about Theranos. You talked about how Khosla is very interested in life sciences. Bill Maris had some very interesting things to say. I'm actually going to quote him because I thought it was such a spicy comment. He said, the reason that Google Ventures did not invest in Theranos is we looked at it a couple of times, but there was so much hand waving, like, look, over there, that we couldn't figure it out. Did you have that response? I mean, I'm assuming you had a chance to look at the company?
Well, I'm not an expert in this space. My partners, Samir Kaul and Vinod, actually are fairly knowledgeable. I think it's fascinating. I suspect, often when there's a lot of smoke, there's some fire underneath. I don't have the expertise to predict, how much of what they claim is true and how much is false. I definitely know that there's a lot of true experts in the field that are pretty dubious and cynical and skeptical. So it's not just the media. It's actually, if you talk to researchers, people who have been pioneering in that world, they're incredibly skeptical. Now, that doesn't mean that's the right answer. Most experts in most fields wouldn't have predicted most innovation and most innovative companies, but it's pretty deep, their skepticism, and they can walk you through a lot of analytics about why it's almost impossible. Okay. But almost impossible, not impossible.
Not right. Before I let you go, Khosla owns 17% of Square. I realize you can't really talk about it very much, but theoretically, how do you feel about a CEO on a road show who is also the CEO of another publicly traded company?
Well, I think people forget there's a small class of people that would be excellent CEOs of a publicly traded company. And in that class of people, the ability to do things that most normal people shouldn't do is probably higher. Right, so it's not the random pool of individuals. We're not just picking people off the street here and saying, be CEO of this company, be CEO of that company. But of the pool of people who are amazing CEOs, could some of them navigate two companies? Probably yes. I think there's a lot of evidence that both companies are doing really well. Twitter's clearly improving its product execution, its culture, and I'm sure the economic performance will continue. And Square's doing very, very well.
Keith, thank you so much.
Thank you.
So great to see you.